Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss restricted stock vesting, understanding legacy gifting options, as well as gift splitting, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we today, good sir?
Doing well. Just enjoying summer. I love, that it stays light so much later. You can get out and be more active. I wish it was like this year round.
Well, we could always move to Alaska. Well, I guess only half the year.
Yeah. The other half will have to be in Buenos Aires or somewhere. Yeah.
All right. Well, let's dive right in. Restricted stock vesting. People tend to mishandle equity compensation by treating restricted stock units like a stock pick instead of compensation. We've kind of discussed this a bit at times. But really, why is it that they're really messing it up or misinterpreting exactly what restricted stock vesting is and how it works?
Yeah, I mean, I think partly it's that restricted stock really is kind of a combination of two different decisions, right? If you take a job with your employer, obviously, you're going to look at salary, benefits. But in a lot of industries, you're also going to look at stock-based compensation, which can be a big part of the total compensation package. And really, what restricted stock is, it's the employer just paying a bonus, but instead of paying it in cash, they're paying it in the form of the company stock, right? So, okay, that's the compensation side. But then now, you have this stock that really is becoming more of an investment decision. Right? Is this a stock that I would want to buy? How does it fit into my portfolio? Would I own this much of this company if I had just received the cash and could have invested in anything, right? But too often, because they're combined, it's just kind of seen as as one decision, right? It's like, I was paid in company stock, so I hold the company stock, which can, cause people to, make some poor decisions on the investment side, or maybe as a part of their overall financial plan, because they just kind of leave that part on autopilot.
Yeah, when we were talking about or when I was reading this, I was thinking of a headline situation of this that hit the news, and I remember when it was Sirius XM and Howard Stern, and he had sold off a bunch of stock, and people like, see, he doesn't believe in the company, and that's a bunch of people that don't understand the reality of the situation. And he even stated, no, I work with a financial advisor. He said, due to taxes, this was the thing that they recommended me doing, which I think that's probably first and foremost one of the things that needs to be taken into account.
No, that's a great example, right? They wanted to bring Howard Stern on. They offered him, $100 million or something like that, which they did not have in cash. So they paid him in stock, right? Now, he looked at it as, this is a business arrangement. I could have gone other places. They would have paid me cash, right? This is kind of the same thing. Then why would I hold on to, all of this money in that stock when that's not really what the core of the negotiation was, right? And so, when the stock vested and it became his, he sold it because he said, that's my compensation. And I'll pay taxes on it, but that I would have anyway, right? And I'll take the investment side and the longer term financial planning side and treat that separately, and then can determine how much of this one company I may want to own as a part of that broader picture. Which I think for more people to follow that lead and think about it that way can be very useful. The problem is, you run into some of these behavioral finance quirks, right, that we all have that maybe we don't realize it. One of them that economists have studied is called the possession effect. And for whatever reason, we value something that's ours more than we value, when it's, let's say, being offered for sale, right? And in fact, I just saw you were taking a sip of your coffee. They did a study, and it was around a coffee cup, right? It was at a university, and they just had a university logoed coffee cup, and they asked the students, okay, how much would you pay for this, right? And on average, they said like, oh, well, $3 maybe, right? I don't really need a coffee cup. I don't really care. Then they reversed the study and they gave the students the coffee cup. And then the question was, how much will you sell that for? And the average was $5, right? So they valued it differently once it was theirs. It somehow, had greater value than if it was, out there and you could buy it or anything else with your money, right? And I think you see a little bit of that with restricted stock. Once people have it, that possession effect, they think it's worth more than it actually is. Whereas if they were starting fresh, they probably, maybe wouldn't own as much of that stock.
Yeah, yeah, it's a really interesting scenario. Of course, not one I've been faced with, but I like the way you put it here, as far as not someday money, not house money, but the payday. Like, when are you going to turn this into something of actual value? Because until my tell me if I'm incorrect, until you really go to sell it, it doesn't have any value, right?
Well, or at least it can't be deployed to work for other goals, right? I mean, it
Right.
has value, but yeah, it's not useful value until you have that plan. So yeah, that's kind of, I think, the thing we keep circling around is that you want to have a plan, and you want to understand the not just the behavioral finance things that might be causing you to make some of those common errors, but also the increased risk, right? Having a large amount of money invested in your employer and your employer's stock, you're kind of putting both your income and your wealth at risk. And if the company goes through a tough period, misses their earnings targets, revenue guidance gets cut, if they're announced they need to do layoffs, not only is potentially do you have that career risk, but you could also see, the stock also moving down in a similar vein, which could have, double the risk or double the negative consequences.
Where do we see a lot of that resistance around the taxes around this? We've talked about the psychology in previous episode of, well, I just don't want to pay taxes on it, without understanding. No, that might actually be a good thing, because it's a sign that you gain some wealth in another aspect. How does that really play into this when it comes to restricted stock vesting?
Yeah, and that's the interesting thing, right? So nobody says, "Oh, I don't want that bonus because I don't want to pay taxes on it," right? We all understand there's no 100% tax bracket. We'd rather, take the bonus and pay the taxes and then have the flexibility to do something with that money. Same with restricted stocks. When they vest, you're taxed, but just because you already paid the tax on the base amount, if it's increased in value, you should view that as, similar, right? Similar type compensation. Or when you get into some of the other areas of stock-based compensation, like, non-qualified stock options or incentive stock options, which can have some different kind of more flexible, but also trickier, tax implications. A lot of times people will just focus on that tax part, right? And not the bigger picture of, okay, how much flexibility do I have here within my financial plan? What are the risks? This is compensation. Should I take the risk of leaving that compensation on the table, or convert it into, maybe a more diversified portfolio or something where you can, take a bigger picture perspective with that asset?
Yeah. What about situations where there's non-qualified stock options? How does that differ?
Yeah, so when those vest, there will be, we'll create a tax at ordinary income similar to a bonus. But you can determine when you exercise those options.
Uh,
And so it does allow, typically there's a 10-year, time period. So it allows for some flexibility. Meanwhile, incentive stock options are taxed both based on when they're exercised and when the stock is sold. And there's different tax ramifications. Gets kind of complex. We won't go into all the details, but you can deal with alternative minimum tax as well as capital gain rules. But again, you have more flexibility on the timing. which can be valuable, but you don't want to just let that specific time period and the taxation drive the entire decision.
Yeah. What is the default sell exactly?
Well, so the first thing is typically when shares vest, people will sell enough to cover the taxes,
Hmm.
right? Which makes sense because you don't want to, if you pay the taxes out of separate money, in a way, you're actually buying even more of the stock, right? Because the stock is vesting, and now you're putting outside resources in so that you can hold on to even more of the stock, which can compound the problem. The other thing is it's important for people to understand that a lot of times the tax withholding that's withheld may be short. There's default tax rates, and they're not always sufficient to cover the entire the entire tax liability. But I think, you can also set up just certain systems where you say, okay, I'm going to limit the amount of stock to X% of my overall net worth or of my investment portfolio. And then as these things vest, use that as a guide to go in and sell and pare it back and, shift those resources to other goals, whether it's funding an emergency fund or paying off debt or building a diversified investment portfolio or a down payment on a home, right? All of those, different other financial goals that this is a resource that it can help fund it.
Yeah, in the personal financial review, it says the magic here is removing the monthly debate. What exactly is the monthly debate, and how does that kind of play into what should the concentration limit be as well?
Yeah, I think the monthly debate is always, should I sell this month? What's the stock price going to do? What's this worth? And so often you see people ride the stock up, and so now they've been compensated well for the work that they've done. In many cases, they partly got compensated well in stock, and the stock appreciated, and that was a trade-off for taking a lower salary, right, or a lower bonus. So it is part of that overall compensation. But as they're watching that stock price go up, 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 they just, fall in love with it and just keep building their position while it's appreciating. And then when it rolls over, right, suddenly now they can see a pretty large drawdown and money that they were already thinking could go towards other things. So if you have that discipline of, like you said, eliminating that monthly debate of should I sell this month? No, you're going to, sell and kind of average out of the position. Then you keep that risk manageable of the possibility of a potential decline that could be pretty painful.
Yeah. Would you speak to the concentration limit?
Yeah, so a concentration limit is just how much do you want to have concentrated in one investment.
Hmm.
I mean, there's many different ways to look at it based on a person's financial goal, net worth, things like that. I know for us, generally, we don't like seeing one company be more than 5%.
Hmm.
I mean, this is just one company. It's going to be affected by a lot of factors that may be specific to that company, but maybe not affect the market as a whole. And so if suddenly there was, some really bad press or, key person leaves or a major earnings miss because competitors are, coming in and stealing market share, you could see that company really get hit during a period where, maybe the broader market's doing just fine. And so, yeah, that added concentration risk, in finance, we would call it systemic and non-systemic risk.
Hmm.
The systemic risk is the risk of the market, right? So we take that on when we invest to try to get those higher rates of return above, some very low risk type investment. The non-systemic risk is the company specific risk. And so that can be a whole variety of things that could affect just that company, but not necessarily the market as a whole. So when you invest in a single company and when you have a highly concentrated position, you're taking both systemic and non-systemic risk. So by definition, the risk is higher. Therefore, your expected rate of return should be quite a bit higher to compensate for that risk. And if it's not, or if you realize that company maybe can't continue to produce those higher than average results over the long term to compensate for that higher risk, then it makes sense to, have a cap and say, okay, it's only going to be a certain percentage of the portfolio, and, you'll sell in the most tax efficient way that you can, to limit that, even though it may still mean paying a decent sized tax bill. That risk management value over the long run can be really important.
Yeah, it's really coming from, I guess, a place of logic and reason around it, as opposed to emotional. Obviously, if we work for a company, we believe in the company. We want to see it succeed, but these are not two things that are necessarily congruent. You got to come at it from a different angle.
Exactly. Yeah. You can still believe in the company. You can be a loyal supporter, hard worker. But, the second question is, can I afford to hold this much in the company? Right. I mean, I believe that USA Soccer was going to win that game, but I didn't go, bet my entire net worth on it. Right. Because obviously those are two very different considerations.
Yes, sir. All right, let's jump to understanding legacy giving options. Legacy giving allows individuals to support charities while receiving financial and tax benefits. So let's kind of run down some of the common ways of doing so and some of the misconceptions. Obviously, with the potential tax benefits, lifetime income or estate planning advantages. The best option really depends on the donor's financial goals and the assets they want to give. So let's start with a charitable gift annuity and the facets of that.
Yeah, well, so first I want to kind of circle back. So with all
Okay.
of these, it really centers around charitable intent,
Hmm.
right? So a lot of these tools are sold based on, oh, look at the tax benefits, look at the cash flow benefits, look at this, but they really don't work unless they're combined with a charitable intent. So, that needs to be the start, that someone, has a charity that's important to them, that they want to support. Then the question is, how do you do it most efficiently from an overall financial standpoint, right? How do you get the cash flow and tax benefits and et cetera, and kind of maximize those in addition to transferring that value to the charity. So a charitable gift annuity is a common one. It's something people can set up independently, but a lot of times you see large charities will have their own program, right? And they'll promote it as, oh, you can, gift to, this charity or this university, and in return receive lifetime payments. And so the idea is you give the money to the charity, they're able to sell the investment, right? Which if the investment's just cash, that's not a problem. But let's say it's a appreciated stock or appreciated real estate where you would be taxed if you sold it. By donating it to the charity and having the charity sell it, you don't have that upfront tax ramifications, right? So immediately there's more value because of the tax benefits. And that value can be split between an annuity, monthly or annual payments that go to the donor that maybe replaces some of that value within their financial plan, right? To help them meet their cash flow needs while at the same time getting tax benefits. And then at the end, whether it's a certain period or whether it's when the donor or the donor and their spouse, if it's structured that way, pass away, any remainder goes to the charity, which they can then use for their benefits, which of course, the remainder amount in that case is uncertain, right? Because it's going to be depending on, the rate of return. But there's formulas that are used by the IRS to kind of gauge, what's the long-term value to the donor, what's the long-term value to the charity, how much of that is considered a charitable donation. But it can really create a win-win where you can take a highly appreciated asset, give it to a charity, still receive income from that asset over your lifetime, and in the end, fulfill that charitable intent by the remainder amount going to the charity.
Yeah. How did the Secure Act 2.0 play into this, or maybe change the way that people took a look at their donations and gift giving?
Yeah, so these charitable gift annuities have been around for a long time, but the Secure Act 2.0 basically said people that are over age 70 and a half, right, which means they're eligible to make qualified charitable distributions. Now, the most common qualified charitable distribution is just sending money directly from an IRA to the charity, right? And then the person's not taxed on the funds coming out of the IRA, and the charity gets the money. So again, it creates a win-win from a tax standpoint. But there's a kind of lesser known provision in the Secure Act 2.0 that allows a one time where an IRA can fund a charitable gift annuity up to 55,000. At least that's the limit for 2026. So basically, gifted into this annuity where they can receive some benefit in terms of cash flow in addition to the tax benefits.
What about when it comes to maybe larger gifts that are given?
Yeah, so individuals that are looking to do larger gifts may not use a charitable gift annuity, through an organization or something like that, but rather set up their own plan. And most typical you see are charitable remainder trusts. So there's two types. There's a charitable remainder annuity trust that basically pays a fixed amount each year in income to the donor, and then a charitable remainder uni trust that pays a percentage of the trust value each year. So the annuity, it's going to be a fixed amount. It's going to stay the same year after year. The uni trust, because it's a percentage of the value, it's going to increase or decrease, right, based on how the investment performance and the distributions, the change that those create in the value, you'll get a percentage. So it's a little bit more flexible in that if the portfolio does well, you can participate in the upside, but if it doesn't do so well, you also have to take part of the downside. And these are typically private trusts that people set up, really their own kind of charitable trust, donate the property, name a charity that really doesn't come into play until the end. Then they're able to draw income from it, and whatever remains at their death would then be paid directly to the charity.
Gotcha. So in essence, it's just kind of one of those situations of taking a greater look. Obviously, when it comes to charity, all of us donate from our heart on that, but really what the overall goal is, but at the same time, logically looking from a standpoint when it comes to trust and so on.
Yeah, yeah. I mean, as we said at the start, the charitable intent needs to be there, right? You're never really going to extract more value out of this type of arrangement. But if the charitable intent's already there, it's one of those where, can you kill two birds with one stone, right? Or three birds with one stone by meeting multiple goals while still, fulfilling that charitable intent goal.
All right, let's jump on over to gift splitting. We've talked about gift splitting before in the past, but it's good to do a refresh because some things have changed. So, what exactly is gift splitting? And let's go into the 2026 numbers.
Yeah, so we've talked about, in 2026, any individual can give another individual 19,000 without, it's basically the de minimis amount. They don't have to file a gift tax return. It doesn't subtract from, their lifetime exemption in terms of the amount that they can gift or leave after death to individuals. So it really just doesn't even need to be reported in any way. It's not deductible to the giver, but it's not taxable to the person receiving it. It's just kind of ignored. But what a lot of people don't realize is a married couple can elect to do what they call gift splitting, which means they can each give 19,000 to an individual. So now that bumps the total up to 38,000, double the annual exclusion for a single person. And the same thing, it doesn't affect the, lifetime exemption. It doesn't, have any of those other potential negative repercussions. So, it is something for people to consider. And, they can kind of, share the gift splitting. If one wants to give more than 19,000 to one person, the spouse can sign off on it, and then, the other vice versa, which can be a great way to, shift assets, even appreciated assets or other things out of someone's estate, or just to give it early, right? Like a lot of people say, oh, I don't want to wait till I'm dead. I want to make gifts now because I want to see them enjoy it.
Yeah. Yeah. What are some of the important aspects that people do need to understand about this? I mean, you stated, there's nothing to file on either end as long as it meets or is under that mark. But are there other aspects that people should know?
Yeah, I mean, with the 19,000 individual gift from one person, it's really nothing that needs to be done. With gift splitting, that does need to be documented. So there are certain elections that need to be made. So it's important, to plan ahead, figure out what the total gifts or the gifting plan will be. So you have it, structured to meet the goals, but also, make sure everything's documented properly.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We got one item pinned up there. What is it?
Yeah, this is kind of an interesting one. Candace put this together because she heard from a couple of clients just something weird going on. So, we use DocuSign, right, to sign a lot of forms. Actually, great service versus all the cost of mailing forms and delays and everything. But what she noticed is when after people signed forms, in some cases they were being prompted to create a DocuSign account at a fee. Right. And so, obviously we pay for DocuSign so that we're able to use it and send it to clients. But now after our clients sign a form that we've already paid for, they're being prompted to set up their own account. And a few clients have been confused saying, is this something I have to do now to be able to continue to use this service? And it's not, right? I mean, all they need to do is just simply select the option that they decline to create an account. They don't need to pay anything to DocuSign because we've already paid on our end. But we want clients to know if they have any questions about the signing process or the message, or they're unsure about what to click, feel free to reach out and contact us, and we'll make sure that it's set up properly. We don't want our clients paying for a service that they don't need to and likely wouldn't benefit from.
Yes, absolutely. I had that as well, and I went, would you like to? Not you have to. So the wording is there that makes it clear, but glad that was included in there. Anything else you want to add before we wrap this up, Chase?
I just hope everyone had a great 4th of July and a good summer, and the fall and kind of the busy fall planning season will be here before we know it. So we'll be ready.
Yes, sir. Well, thank you for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button on whatever audio platform you're listening on if it's your first time. Or you can also go over to our YouTube channel, youtube.com/@plansolutions, and you can follow along to a visual form of the podcast that has the personal financial review on screen and follow along as Chase and I discuss. And if you have yet to subscribe to the personal financial review, it's simple to do. Just send Katie an email, katie@plansolutions.com, and let her know you want to get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.